In the previous episode, we opened up the quote to cash process and followed a customer transaction all the way from CPQ, contracting, order management, fulfillment, billing, accounts receivable, collections, and payment. But here's an interesting question. Does all of this actually happen inside one system? Usually, no. In a real implementation, the quote to cash can span multiple systems with customer information, product information, pricing, contract, order, billing and payment information, and other financial information constantly moving between various systems. And this is where understanding quote to cash starts becoming really important for us as consultants. Because it's not enough to know what each system does individually, you also need to understand where each system fits, what information it owes, and how it connects with everything around it. Welcome back to the Quote to Cash and ARM Playbook with Anand Ramakrishna, a Go to Mentor series. Let's continue with the example we have been using. A startup has hired 20 employees and approaches a technology supplier. They are buying 20 laptops, 20 docking stations, 20 antivirus subscriptions, a 3-year extended warranty, and premium IT support as a recurring service. One customer, one commercial transaction, but potentially many different systems working behind the scenes. There are 8 major areas in this journey where different systems and capabilities can come into play. Let's walk through each one of them. CRM. The relationship usually begins with a customer relationship management system. Sales needs somewhere to manage the relationship with the customer. Who is the customer? Who are the people we are talking to? What are they interested in? For example, our salesperson may create the startup as an account, identify the IT director and procurement manager as key contacts, and create an opportunity representing the potential sale. As the deal progresses, sales also needs to track the potential value of that opportunity, the activities taking place, and where the customer is in the sales cycle. That's broadly the role of CRM in our journey. Platforms such as Salesforce, HubSpot, and Microsoft Dynamics provide CRM capabilities. Since many of you watching this series come from the Salesforce ecosystem, let's double click on Salesforce. Within Salesforce, Sales Cloud, now rebranded as Agent for Sales, is one of the primary offerings used to support CRM and sales capabilities. It helps sales manage things such as accounts, contacts, leads, opportunities, activities, and the overall sales pipeline. And I want you to understand an important distinction here. CRM is the business capability, Salesforce is the technology platform, and Sales Cloud is an offering on that platform that helps enable that capability. That distinction becomes increasingly important as we move through this series. Eventually, once the customer has a measure of confidence, they say, we have our requirements and we would now love to understand more about your products and services that we are interested in buying. And now we move deeper into the quote to cash process. We move from CRM into CPQ, or the configure price quote. Before we can quote anything, the business needs to know, what do we actually sell? Our product catalog might contain several laptop models, different RAM and storage options, compatible docking stations, multiple antivirus subscriptions, warranties, and support plans. And importantly, not everything can necessarily be sold with everything else. Perhaps one docking station is compatible only with certain laptop models. Maybe the company offers silver, gold, and platinum support plans, each providing a different level of service. Maybe a 3-year extended warranty is only available with certain laptop configurations. Those are all examples of the commercial rules that help determine what we can actually sell. This is where the product catalog becomes important. Think of the product catalog as the commercial definition of what the business sells. It is products, services, bundles, options, and the rules around how they can be sold. Then, for this particular customer, we need to determine what is the right combination of those products and services. Maybe they select a particular laptop with 32 GB of RAM and 512 GB of storage, a compatible docking station, a 3-year warranty, an antivirus subscription, and gold support. Notice something important here. Configuration is not necessarily just about configuring a physical laptop. We may actually be configuring the overall commercial solution that we are going to sell to the customer. Hardware, software, subscription, warranties, and services together. Once we know what they are buying, we need to determine how much should they pay. Maybe the laptops have a standard list price, but buying 20 quantities qualifies the customer for a volume discount. Perhaps the customer also has negotiated pricing because they are an existing strategic account. And if the salesperson wants to offer an additional 25% discount, maybe that requires approval from a sales manager or deal desk. That is pricing. Finally, we bring the configuration, quantities, pricing, discounts, and the commercial terms together into the quote that we can present to the customer. That's where configure, price, quote, or CPQ capabilities come into play. And within the Salesforce ecosystem, product catalog and CPQ capabilities are an important part of Agentforce revenue management. That is, two systems. Next, we have the contract lifecycle management. Now, the customer likes our quote, but perhaps they're saying our legal and procurement teams need to review the agreement. Now we are dealing with contracts. For example, our standard agreement might say net 30, but this customer negotiates net 60 payment terms. Our standard support agreement might promise a certain response time, but this customer may want a more aggressive service level agreement. Or perhaps they have committed to a 3-year term but want the ability to terminate early under certain conditions. These aren't simply product and pricing decisions anymore. They are contractual commitments. The agreement may therefore go back and forth between the seller's legal team and the customer's legal or procurement teams. Clauses may be redlined. Non-standard terms may require additional approval. Eventually, both parties agree and sign. A contract lifecycle management or CLM solution helps manage this lifecycle, including contract creation, negotiation, approvals, execution, amendments, renewals, and eventually expiration or termination. And depending on the enterprise architecture, CLM may be part of the same technology ecosystem, or it could be a completely separate application. That is System 3. Next, order management and fulfillment. Now we have agreed on the products, the price, the contractual terms. But just like in our previous episodes, the customer still does not have anything. We need to convert that commercial commitment into an order that can actually be executed. This brings us into order management. And here's where the system landscape gets interesting. Remember what our customers purchased. The 20 laptops and docking stations need a physical fulfillment. An ERP or inventory systems may tell us that 12 laptops are available in one warehouse and the remaining 8 are available somewhere else. A warehouse management system may then help the warehouse teams pick, pack, and prepare those products. And a logistics or shipping system may coordinate their delivery to the customer. But what about the antivirus subscriptions? We don't put those into a cardboard box. They may need to be electronically provisioned through a completely different system. The extended warranties may need to be registered and associated with the serial numbers of the individual laptops. And premium IT support may need to be activated inside a service management platform so that the customer is actually entitled to the level of support they purchased. So, notice what happened. One commercial order has now created several completely different fulfillment requirements. Physical products need to be shipped. Digital products need to be provisioned. Warranties need to be registered. Services need to be activated. This is why order decomposition and orchestration become so important. And within Agentforce Revenue Management, This is where capabilities such as dynamic revenue orchestrator becomes particularly interesting. Don't worry, I got you covered here. We will dedicate separate episodes to those concepts. For now, remember, the commercial order may originate in one system while the actual fulfillment can happen across several others. That's system 4, billing. Now we have sold the products and services and started fulfilling our commitments. So the next question is, how and when should we bill the customer? This takes us into billing. And again, our transactions isn't simple because everything the customer purchased may follow a different billing model. As discussed earlier, the laptops and docking stations might be billed upfront. The antivirus subscriptions might be billed annually, premium IT support might be billed monthly, and the 3-year extended warranty might be charged upfront for the entire term. Now, imagine we also sold a cloud storage service where the customer pays based on the actual consumption. In that case, the billing systems may first need to receive usage data before it can even calculate the amount to invoice. So, billing isn't simply about pressing a button and generating an invoice. It needs to understand what is billable, how much to charge, when to bill it, and how frequently the charge should recur. It may also need to account for adjustments, taxes, credits, and the customer's agreed payment terms. All of that ultimately comes together to generate an appropriate invoice. Agentforce Revenue Management also provides billing capabilities that can support these types of revenue models. But again, depending on the architecture, billing could also happen somewhere else. That is System 5. And since I mentioned tax, let's spend a little more time on tax management because this is another area where code to cash can become surprisingly complex. The first thing to understand is that tax rules can vary significantly depending on where you're doing business. In the United States, for example, you may be dealing with sales tax, and the applicable rates can vary by state and even by local jurisdiction. In Canada, you may encounter GST, HST, or provincial sales tax depending on the province. In India, we have GST. And in many European countries, you will commonly encounter VAT, value added tax. But geography is only one part of the equation. The tax may also depend on what you're selling, who you're selling it to, and where that product or service is ultimately being delivered or consumed. Here's the part that matters most for you as a consultant, not just as someone learning CPQ terminology. These rules don't write themselves. Every single one starts as a business requirement someone has to surface, usually buried inside a conversation with product management, support, or finance, not stated outright. A physical laptop may be treated differently from a software subscription. A taxable product may be sold to a customer who has a valid tax exemption. And a transaction involving multiple countries or jurisdictions can introduce an entirely different set of tax rules. So, the system may first need to determine which tax rules apply and then calculate the appropriate tax. For relatively simple tax scenarios, a business might maintain a tax rate or tax table directly within its application. But as the business grows across multiple states, provinces, countries, and tax jurisdictions, maintaining all those rates and rules internally can become extremely difficult. That's why many enterprises use specialized tax engines. Instead of trying to recreate every tax rule inside your quote to cash solution, the transaction can be sent to a tax engine which determines the applicable taxes and returns the calculated amount. So when you are designing quote to cash solution, tax management isn't simply add 10% to this invoice. It's about determining whether tax applies, which tax regime and jurisdiction apply, what rate should be used, whether exceptions apply, and how the tax should ultimately be calculated and reported. And depending on those business requirements, those capabilities may be handled natively within the solution or through integration with a specialized tax engine. We will dedicate a separate episode to tax management and tax integrations later in this playbook. For now, I simply want you to recognize that tax is another critical capability that can sit within or integrate into the broader code to cash architecture. So that was system 6. Next up, payments, accounts receivable, and collections. Now we have generated the invoice. But remember, an invoice is not cash. Suppose our invoice is for $40,000 and the customer has net 30 payment terms. That means we have billed them, but they may not actually pay us for another 30 days. During that period, the 40,000 represents money the customer owe the business, part of what we call accounts receivable. The customer may eventually pay through a bank transfer, credit card, ACH, or another payment method. That transaction may involve payment gateway or payment processor. Once payment arrives, it needs to be associated with the appropriate customer and invoices so that the business knows what has been paid and what remains outstanding. But suppose day 30 arrives and the customer still has not paid. Now, dunning and collections may come into play. Perhaps an automated reminder is sent. If the invoice remains unpaid, another reminder may follow. Eventually, the account might be escalated to a collections team. So, billing created the invoice, accounts receivable tracks what the customer owes, payments brings the cash into the business, and collections help pursue amounts that have become overdue. Depending on the organization's architecture, size, those capabilities may live in different platforms or may be consolidated within a broader financial system. All right, so that was system 7. Next, ERP and financial accounting. And finally, everything we have just done has a financial impact. When we create invoices, receive payments, calculate taxes, issue credit memos, or make billing adjustments, those aren't merely operational transactions. They ultimately need to be reflected correctly in the company's financial books. This is where an ERP or financial accounting system often becomes extremely important. Systems such as SAP and Oracle frequently play this role in large enterprises. For example, the invoice we generated may create an accounts receivable balance. When the customer pays, that receivable may need to be cleared. Different transactions may generate journal entries that eventually flow into the general ledger and contribute to the company's financial reporting. And depending on what we have sold and when we have fulfilled our obligations, there may also be implications for revenue recognition. Don't worry if many of these terms are confusing. We are not going to unpack all of that here because each of those concepts deserve its own episodes. But as an ARM consultant, I want you to start recognizing these terminologies and understanding where the transactions originating in your quote to cash solutions may ultimately end up. I hope you are enjoying all of this content. What we just discussed was System 8. Now, let's zoom out. Look at what happened. One customer wanted to buy a combination of products and services. But behind this apparently simple transaction, we potentially had a CRM managing the customer relationship, a product catalog defining what we sell, CPQ helping us configure, price, and code the solution, a CLM system managing the contractual agreements, order management coordinating what we have committed to deliver, inventory, warehouse, logistics, provisioning, and service systems helping fulfill those commitments, billing determining what and when to invoice, a tax engine calculating applicable taxes, payment systems helping us collect the money, accounts receivable and collections helping us track and pursue what the customer owes, and an ERP or financial system helping account for that financial impact. And then we need integration technologies connecting all of this together. That's a very different picture from simply saying we are implementing Salesforce. System of record. And here is where I want to introduce an extremely important architectural concept, system of record. When multiple systems participate in quote to cash, we need to understand which system is authoritative for each major piece of information. For example, perhaps Salesforce is the authoritative source for the customer and opportunity. Maybe ARM owns the commercial product catalog and pricing. Perhaps the signed contract is mastered in CLM platform. An order management system may own the executable order. Billing may own the invoice, and the ERP may ultimately own accounts receivable and the general ledger. I'm deliberately saying perhaps and may because there is no universal architecture. In another company, those responsibilities could be completely different. And that's exactly the point. As a consultant, don't simply assume where the data belongs. Ask which system owns it. Because if two systems both believe they are authoritative for the same information, you can very quickly create data quality and integration problems. And then comes integration. Because having all these systems is only half the story. They need to talk to each other efficiently. Imagine sales has just closed our laptop deal. The order management system needs to know exactly what was sold. The fulfillment systems need to know what needs to be shipped, provisioned, registered, or activated, and by when. Billing needs to know what became billable and according to which billing schedule. When the customer pays, that information needs to flow back so that the appropriate receivable can be cleared. And finance ultimately needs accurate information so the transaction is properly reflected in the books. So when we design these integrations, we are not simply drawing arrows between boxes. We are asking what information needs to move, which direction, who owns that information, where does it need to go, and at what point in the business process should it move. Those arrows represents business events and data moving between systems. And every one of those arrows has to work correctly for the end-to-end quote to cash process to work. And then comes another critical question. What happens when something goes wrong? What if the order is created but provisioning fails? What if fulfillment succeeds but billing never receives the update? What if payment is received but cannot be matched to the correct invoice? Now we are talking about integration failures, exception handlings, reconciliations, and data integrity. These are architecture questions, and as you progress in your career, they become just as important as understanding how an individual feature works. Business process first, technology second. So, if there is one thing I want you to take away from this episode, it is this: Quote to cash is the business process. CRM, CPQ, CLM, order management, billing, ERP, and all the other applications we have discussed are technologies and capabilities that enable different parts of that process. There is absolutely no rule saying that every company needs a separate application for every capability. One technology platform may handle several parts of the quote to cash. Another enterprise may have a highly distributed architecture involving 10, 20, or even more applications. That's why, as consultants, we need to understand the business process first, the technology second, and then understand how the technology fits together to enable that process end to end. Because once you understand that, the questions you ask become much more meaningful, relatable to the business, and instead of simply asking which Salesforce feature should we configure, you start asking more intelligent questions. Where does this information originate? Which systems should own it? Who needs it downstream? What business event should trigger it to move? And what happens if that flow breaks? Those are the kind of questions that help you move from simply understanding a Salesforce product to thinking like a quote to cash consultant and solution architect. Now, we have looked at the process. We have looked at the steps inside that process. And now we have also looked at the systems that enable it. But we are still missing one extremely important part: the people, stakeholders. Because every one of these systems ultimately exists to support the people performing different roles across the business. Sales looks at our laptop transactions one way, legal looks at it entirely differently. Order management cares about something else. Billing has its own concerns. Credit management has another perspective. And finance may look at exactly the same transaction through an entirely different lens. Same customer, same transaction, completely different priorities. And that's exactly what we will explore in the next episode of the Code to Cash and ARM Playbook with Anand Ramakrishna. I'll see you in the next one.